All right, so let's talk trade talk and risk and the recession that's been warning, the signals that are coming from the bond market. Joining us for that is Victoria Fernandez. She is chief market strategist at Crossmark Global Investments. On set with us is Joe Zock. He's portfolio manager at Tocqueville Asset Management. Welcome to both of you. Victoria, let's talk about this. We've been trying to figure out if the inverted yield curve is something we need to worry about. You say at this point you're not worried. Why is that?
Yeah, no, we're not worried at this point. We don't think a recession is imminent. Yes, we have this inversion of the yield curve. I mean, that's more of a signal that investors think the Fed is not accommodative enough. But I think there's a lot of stuff going into that, mostly being the uncertainty. I mean, this consumer is still strong. The fundamentals are really good. Yes, we've had a slowing in manufacturing. We've seen that both globally with the Eurozone PMIs and here domestically. But look, durable goods were good this week. Regional manufacturing surveys have been really strong. So I don't think we're on the verge of a recession. I think we need to pay attention to what the yield curve is telling us, but I wouldn't trade on the headlines or trade on this inversion at this point in time.
Joe, the big question everybody has is, will we talk ourselves into a recession? Will we bring confidence down? And you do a lot of research where you talk to management teams across the country, and you have a real good feeling for what management teams are thinking right now. Are they starting to lose confidence based on what we see?
No, and there's a wide spread between what I hear from CEOs and CFOs and what I read in the newspaper or hear in other publications. So I'm closer to Joe's opinion that the underlying economy is strong.
Joe Terranova. We've got three Joes on set with us right now.
Right. I'm not going to put the other two on the spot and ask you if you know about the 7 fat cows, but at any rate, the conflict between what I hear from CFOs and CEOs and what I read in the paper is dramatic. So something's got to give, and I think that the inverted yield curve is strictly a short-term phenomenon.
What level companies are we talking about? Are you talking
everything
Fortune 500? Are you talking small businesses?
Everything from large cap names, the top 50, to smaller cap names. And I see the same trend in their rhetoric. So some, the way they used Y2K years ago, some are using the China trade as an excuse to say, oh, our earnings didn't meet expectations or we have a shortfall. But most are just saying we have to solve the supply chain dilemma.
Are they willing to put money to work? Capital investment has been the huge issue. It hasn't been as strong as people had expected this year.
I think that you see some caution there. I think it's just the M&A trend that you thought might occur with interest rates this low. It's easier to bolt on a new source of earnings than it is to organically grow it. I think that's softened a little bit, but I can't predict when that would retool.
But that's really about manufacturing. If you look back and just look at the steel industry, look at where it is, the automakers, the production costs for automakers, the production costs for the oil and gas industry as a result of the tariffs from steel and aluminum have risen dramatically. So CapEx is declining specifically in manufacturing. Manufacturing, you could argue, is in a technical recession, somewhat similar to what we saw in 2015 and 2016. So that it seems to be isolated right now to manufacturing. The steel industry, for me, is in a very perilous position. And the question becomes, you've got these two distinctive elements of the economy that are kind of barbelled in a capacity that technology and the consumer looks phenomenal, but then on the other side of it, how do you heal the pain that you're experiencing in the manufacturing sector? There's got to be some form of relief at a certain point to them.
So we see a significant transition from old line manufacturing to new technologies, whether it's in automobiles or other machines that you might use, robotics, things of that nature. So I think you'll see that improve, but there is a gap right now. There's a transition that has to take place.
Victoria, go ahead.
No, I was just going to say, in regards to the CapEx, too, I mean, I think we have to look at where the Fed is sitting. I don't think another 25 or 50 basis point cut is going to affect that CapEx. I don't think they're not investing right now because they think rates are too high. They're not investing because of the uncertainty that's going on. So it puts the Fed in a more perilous position because they want to lower.
Pushing on a string. You lower interest rates, and that's not the reason that corporations aren't investing at this point. Victoria, if you don't think that we are reaching a recession point, what stocks do you like? What sectors do you like?
Well, some of the names we recently added were in the healthcare sector. We did Edwards Life Sciences. I know that's more of a conservative play, and we've kind of been looking at that, looking at some core names, some value names to do. We also last week went into the home builders. We did Lennar into our portfolio. We've seen the home sector start to come back a little bit.
Because
I know
of
that
lower
the
interest
monthly
rates, lower
number.
mortgages?
Exactly. And we've seen, the number was lower last month, but there was a big revision to June. And so I think the underlying strength was actually better than what people anticipated. And it's that lower end housing where we're missing the supply. So I think Lennar's a good play.